Hey everybody, this is Saim, your crypto CPA from the Lone Star State here at Akif CPA. In today's segment, well, first of all, congratulations for surviving in another year of roller coasters, of uncertainty, of prices being too high, and everything in between. So congratulations for surviving, and let's make 2026 an amazing year for us. Let's make sure that we thrive in this upcoming year and not just survive. So for that, we need to plan. We need to plan ahead. We need to make sure that we do things properly, and especially when it comes to our crypto investments. So in today's hour-long session, we're going to be discussing the state of crypto tax and accounting here in the U.S. and what investors need to know. At the same time, we're going to discuss what changed, what you need to do yourself in terms of homework and bookkeeping, and making sure that you're not getting tripped up by the IRS and the Department of Treasury in terms of how you've been reporting your crypto earnings and other things. And so let's get right to it. I have developed quite a few segments. So let's get into the actual first segment of what has changed this year in terms of crypto tax in the U.S. So what has truly changed in this? Let's see. Let me open up my. And again, disclaimer: I did use AI to get some help in putting this together. And again, I have my own deck that I've been using to in doing presentations. So I'm gonna go ahead and pull up that deck as well. It has a lot of everything is up to date in that deck. So let's get right to it. All right. Here we are, landscape and 1099. So remember, in 2025, the biggest thing that you should have been anticipating or waiting on was the 1099 DAs that are about to be rolled out in January 2026. And the reason why I say that is because everything that has transpired in 2025 will be on that 1099 DA form. So now let's say I'm going to draw something here. Let's say that we are a person, and again, this is from elementary school, and sure, you're a crypto trader. You're a crypto trader of all kind. You're just a badass. Let's put it this way. And you have your centralized exchanges that you connect to. You do the on-ramping. You do all your crypto trades. Then from there, let's just say you move your crypto out to MetaMask or Kepler, some of your self-hosted or self-custody wallets, right? One wallet, two wallet. Okay, so everything that is, let's change the color. Okay, everything that is here in the centralized exchanges will be covered by the 1099 DA. Okay, but everything that is part of your self-hosted or your own wallet, those are not going to be covered by 1099 DAs. You still need to connect those to a third-party crypto tax tool, and you still need to connect your centralized exchange to, and make sure the accounting is done properly. And then in that accounting, this will be your answer for all the MetaMask and all that, and then this will be your answer for the 1099 DA. So you can technically verify both pieces of data here. So this is what the biggest thing that you should have been doing all year long was making sure that everything that you have moved from your MetaMask, Kepler, Pulse, all the DeFi wallets, everything that you've moved over to your centralized exchange, you have actually added the cost basis and the date for that crypto. So then you make sure that, so this is the 1099 DA piece, and this is your self-reporting piece. Okay, so and this is, so the 1099 DA, all of this will go into 8949/Schedule D, right? And this will all go into, could be 8949/Schedule D, plus if you're a minor or somebody, it could be an active activity, it could be Schedule C or other, depending on your activity. And then you also have your income, which is Schedule 1. Or in some cases, they might call it B. Or but Schedule 1, that's crypto income. Okay, so this is what changed in 2025. 2025 it was the year that we were getting ready for the new 1099 DA forms, and also brokers that are issuing these 1099 DA forms, they have 1 year of safe harbor for themselves. And when I say 1 year for safe harbor, basically this year when you get that new 1099 DA, you're not going to get the cost basis. You will get the proceeds box filled out, but not the cost basis. So you will need to make sure that that 1099 DA form is accurate. All right, and then what else? Second thing is the big thing. Second thing is what? It's the making sure that starting January 1, 2025, there is no more universal accounting. So everything is wallet-based accounting. January 1st, 2025. So make sure you're not, losing track of what changed or what happened in 2025. And we have other notices that came out. One came out pertaining to corporations. Basically, they can exempt capital gain taxes on some of their digital assets. We have quite a few. So let's look at real quick my deck, my favorite deck here. So I do this a lot now. I do 101 and actual regulatory framework. Here we are in 2025. We had multiple things. You also had the FAQ got updated 2025-7. This is the one that has codified the wallet-based crypto tax and accounting. 2024-28 was the one that started this right here, and then this is now set in stone. Okay, and then this is the final new one that came out that's pertaining to C corporations or corporations that actually stake in trust, that their staking proceeds that they earn will be exempt. So that is what changed in 2025, and this is what you should have been looking out for. And one thing that again is still valid is tax loss harvesting is still valid. Woohoo! All right. So now this does our segment of what changed in 2025, the state of crypto tax in America and US. What has changed? And even if you live abroad, anywhere in the world, even if you use VPN for your exchanges, the FBAR filing forms, all of that is now intact. So that entire framework of what was needed, how things will play into actual the tax return, which fields will be picked up, how those fields are calculated. Now we're seeing that entire regulatory framework come to fruition. So kudos to the Department of Treasury for laying this out. But again, still, blockchain is a network for the people, by the people. So you will always and always have an element of innovation and creativity that we're going to need to keep these laws up, and we're going to need to do this update of laws more and more. Okay, awesome. So let's now go to the next section. Next section is, all right, wallet-based universal accounting, the shift. The new reality, the safe harbor provisions, and let's talk about what is wallet-based, okay? I'm going to go ahead and draw this out. Today I'm in the mood to drawing, okay? All right, so we're going to do two lanes, okay? This is prior to 2025, and this is 2025 and beyond, okay? So before, let's say that we have, and these are wallets, okay? I'm using a mouse, so please excuse me for not being an artist. Let's say we have 3 different wallets, okay? Prior to 2025, what you could have easily done is you could have, if you're selling crypto from, let's say, wallet 1, you could have easily used the characteristics of the same crypto that you have in wallet 2 or wallet 3. So when you're selling it, so even though, let's say in wallet 1, you purchase crypto at $25, a particular type of crypto, that same crypto you purchase in wallet 2 and 3, let's say you purchased it for $20, and let's just say you purchase in wallet 3 for $30. So if you sold that crypto in wallet 1 here, okay, you could have easily used the cost that you have actually paid for in wallet 2 or 3, because it is the same exact crypto, right? If you purchase Bitcoin in one wallet and you purchase Bitcoin in a second wallet or a third wallet, what are we doing? It's the exact same Bitcoin purchased at different intervals. Price was different, but it is Bitcoin. So when you're selling it, you're mixing it. You're saying, hey, I'm gonna use this one, and I'm gonna use the characteristics of this particular Bitcoin. That was one universal wallet based accounting, and that was absolutely amazing because you could have gotten so creative with this, and but the taxation and tracking of it was absolutely impossible. There was no way for IRS or any other regulatory agency to know what transpired or even try to figure it out, because they wouldn't even have the full data. Even to this day, anytime you have a crypto examination or any letter, you need to. There are 15 different ways that you can analyze it. Basically, this is the situation, right, and come up with a different answer. So the creativity in crypto tax is still there. It's even more intense. So this was universal wallet-based accounting. Prior to 2025, this was allowed. No more after 2025. Now, if you have, let's say, 3 different wallets, all right, wallet. Now, you can no longer mix and match the characteristics from wallet 1 to wallet 2 to 3. If you sell something from wallet 1, it's the same exact thing that you acquired in wallet 1. You can no longer use the wallet 2 acquisition and for wallet 1's disposal or sale. So this is now the actual method, 2025 and beyond, and you need to make sure that you are using wallet-based accounting. A lot of crypto investors are technical, smart. They also want to remain anonymous. So a lot of times they're doing their own accounting, but they're not even picking the right country in terms of their crypto tax software. And if you don't pick the right country, there's no way you're going to apply that country's tax rules. So pick the right country, pick US, and then make sure that 2025 and beyond, you have wallet-based cost tracking. If you did universal prior to 2025, there's a way for you to keep the data static after December 31st, 2024, and then convert to universal. Basically, that's when you have 2 different data sets. So you can do a lot of things, but you need to know what you're doing. And the last thing you want to do is report wrong data, wrong information to the IRS, because then you're opening yourself up to huge amounts of penalties, fees, all kinds of, and right now they're watching the digital asset tax returns, cryptocurrency asset tax returns, like a hawk. So please be careful. So this is what wallet-based accounting looks like. Now you don't have universal accounting anymore. Make sure you're attaching all your wallets when you're doing your crypto tax, and make sure that with the new smart contract 1155. So we first had, ERC20, then we had 721, then we have 1155, then we have 1400, then we have 3643. But again, after 1155 or after 721, we got 1155. 1155 gives you the ability to have ERC20 and 721 combined, along with, so you could have multiple different transactions all lumped up into one smart contract. So it's no longer about just one transaction going in and out. So you need to make sure that transaction is then parsed correctly. You're editing it, you're putting it into that CSV, and you're uploading it. So the crypto tax affairs, and as far as doing the actual accounting, has become complicated. The rules are few, but the applications are just a plethora. So let's go into the next section. All right, let's talk about the income buckets. This is where, again, this is everyone starts off here. They always want to know, what kind of, where do I report my crypto tax earnings? Well, I've never reported my crypto tax earnings, and nothing has ever happened. So why do I need to report it now? I get these questions all the time. Well, you are a U.S. resident or a U.S. citizen, or if you are anybody who's subject to the U.S. Tax jurisdiction, by law, you have to report any kind of income that you make, whether you make it at a family dinner or you're making it at a job or you're making it at while you're consulting or providing some services to somebody and they happen to slide you a $20 bill. So we live under a tax regime that allows you to basically input in your worldwide income, and that includes your crypto blockchain income. So first and foremost, if you're an individual, you have to ask yourself, well, what am I doing? Staking, okay. Liquidity pools, okay. Lending, okay. Projects, cool. If you're doing all this and you're participating in a project, not running the project, okay, you're mostly passive. What does that mean? That means that you're reporting your income if you're staking or rewards or anything that you earn that you didn't have before per the IRC 61, the old gold IRC 61. You're going to report the fair market value of whatever you earn at that time that it hits your wallet per 2024-28. That goes into, at a minimum, Schedule 1 or Schedule B or whatever, because those are all taxed at your federal tax bracket. Okay? Then we can talk about buying and then exchanging, converting, swapping, all of that. All of that goes under Schedule D because you are considered as a passive investor. Again and again. I'm going to repeat that again and again. You are considered as a passive investor, not an active one. And I'll tell you where the active, for the miners, where does all that go into? Schedule D. And Schedule D is a summary, right? Schedule D, the actual details are all in 8949. So you not only have to report the actual exchanges, swaps, conversions to any other crypto. So for example, if you have purchased Ethereum or Solana or Pulse or all kinds of Gala, whatever crypto, when you convert that cryptocurrency for any other cryptocurrency, for example, Ethereum, Bitcoin, that is not the same as the original cryptocurrency, or this. That is a conversion. That is called a taxable event, and you have to have capital gains and losses reporting associated with it. So even the fees that you use in cryptocurrency to transfer or to, when you're transferring it or you're moving it, any kind of fee that you incur, that is also a sale of your crypto, because 99.9% in cryptocurrency, you're paying the fees from also a crypto token. You're not paying it through fiat. But obviously, there's as an individual, you cannot deduct the cost of the fees, but a business can. So 8949, all the fees line by line. You're not doing a summary, ladies and gentlemen. No summaries. No. We don't do that. 8949 has to have all the line by line details. Okay, that goes there. So this is pretty much it for somebody who's been doing cryptocurrency and they want to know. So 8949 is where all the trades are going. So first, doing all your crypto accounting, right? Step one, making sure that if you're on a centralized exchange, if you have Coinbase and all that, first of all, go update the accounting method. HIFO, FIFO, LIFO. We'll get into that in this one. Second, if you're on a centralized exchange, part of your entire crypto tax will now come through the 1099-DA. But the other piece is going to come through you. You will need to report that properly and provide that full data to your CPA. And don't provide them wrong data, please. So this is how you complete it. So then once you complete the actual accounting, you will get the data for all your trades. Where do you plug in all your trades? Form 8949. Form 8949. Where does the 8949 sum up all your trades? To Schedule D. Schedule D. Schedule D. Crypto income, where does that get reported? Schedule 1. Schedule 1. Schedule 1. What if I am a miner? Miner. Okay. A miner or somebody who runs a DAO or somebody who's a NFT artist. Okay. What if somebody who, NFT artist that receives royalties. And excuse me for my spelling here. I'm just going to go fast. Receives royalties. All of those are, because you are considered as active, Schedule C at a minimum, because you are in a business. You are not just investing in cryptocurrency. When you're a miner, you have an operation. You're a business owner. You have assets, whether you're renting those assets or you have your own physical assets. Then you have your income. So all of that is considered as business income. So Schedule C is at a minimum. And for NFT artists, and again, because CPAs don't do this work all the time, NFT royalties and NFT artists are not your mineral royalties and artists. Don't forget that. They are not your mineral stuff, ladies and gentlemen. So NFT artist, all of that goes into Schedule C. It's active. So then there's tax strategies, right? Then we'll get into all that. But this is the whole framework. This is it. And obviously, if you are a business, whether you are a LLC or a C-Corp, or the C-Corp will pass the earnings to you through dividends, whereas the LLC will pass them through you to K1s. And gotta make sure the K1s are accurate. Gotta make sure. I mean, the taxpayers here are just, I feel so bad for them. Because cryptocurrency is now such a brand new asset, and we've fit this brand new asset into such an old framework. So now we're having to just, figure this out. But don't worry, we're here. Well, what do? We make crypto taxes easy. So you spend less time worrying and more time enjoying and running your business, or spending, or going on a family vacation with on a cruise, or wherever you are. So that's what we're doing. All right. Let's talk about, so remember, going into your centralized exchanges, making sure your accounting methods are static all across at a minimum. If you are somebody who's advanced, then there's advanced strategies, right? You can pick, for a few wallets, you can pick HIFO. For a few, you can pick LIFO. For a few, you can pick FIFO, you can pick many different methods. But what goes into one, how the cost basis transfers, you need to nip that in the butt, just strictly. You can't just nilly-willy go and, oh, well, this is going here, this is going, no. We've helped so many people where they've had their business account as LIFO, and they've had their personal account as FIFO, or whatever. But again, the cost basis has to transfer too. But it has to make sense for you. So what does FIFO stand for? FIFO stands for first in, first out. And you can check out a very detailed video that I've put out earlier this year. It's FIFO, LIFO, HIFO cracked. I have a small little pencil that I cracked it. And basically in that video, I go into much more detail as to what method suits best for you, how you need to give it a lot more attention than just looking at a final tax bill or tax liability. So you need to make sure that you're set up properly. There's this tax strategy around it, all of that. So LIFO equals last in, first out. And HIFO equals highest in, first out. So basically the most expensive ones is the one that you're trying to liquidate first. So per the regulation, if you don't pick any of these methods, by default, you're going to FIFO. It's all codified now. But the IRS and Department of Treasury do allow you to pick specific ID. And what do you mean by specific ID? Specific ID means that, let's just say that in a perfect world where you have a whole bunch of crypto. Let's say all these boxes are your crypto. Let's just say this is BTC. Anytime you purchased a crypto at any point, that's unique because the price was different, the timing was different. So let's just say in the universe of all this, you can pick and choose. Each of these boxes are considered as your lots. You can pick and choose each specific lot that you want to dispose first, or sell first, exchange first, convert first. as you're doing your crypto trading and investing. That's called specific ID. So that doesn't mean that you can't use LIFO. LIFO just means chronologically last in, first out. HIFO just means due to price, what is the most expensive one. But in HIFO, you lose the chronological ability in your mind to know what you're disposing. Yeah, sure, this could be the most expensive one, but is it going to give you a short-term or long-term capital gain tax advantages? You don't know. And that's where the high in, first out, especially for those who have a lot of crypto, it breaks in their head because they cannot determine which particular lot is going to come out next unless they have a whole chart and they're seeing all the boxes. So this is the issue. If you are somebody that is more of a hodler and is continuously buying, doesn't give gaps in between, then FIFO is probably the one that you ought to look at. Why? Because it will give you the long-term capital gains, and at the same time, since you're purchasing continuously, it won't liquidate the most recent one that you have that you purchased. So somebody who is continuously purchasing crypto inventory and is holding on to it, FIFO is probably the one that you need to look at. Somebody, let's say, who is continuously going in and out as a spot trader, open position, purchase, close position, sell. LIFO is probably something that you want to look at. Why? Because then your purchase and sales, they're very close to the current market price. That means that they will give you the least amount of taxable gain and the least amount of tax due. So that's how you want to determine if you want to be FIFO or LIFO. But if you are somebody, let's say, that actually has purchased a bunch of crypto, and now that there's a gap and you haven't touched crypto and it's just been, you're hodling it for quite some time, and since you have a gap of a year and you haven't done anything in crypto, then it doesn't matter if you're picking LIFO or FIFO. They're all going to be long-term in nature anyways. At the same time, you will get the least amount of tax due on your taxable gain, and you won't be at a tax disadvantageous because there's a short-term capital gain nature. It will just be all long-term in both. So remember, if you are somebody that is continuously purchasing the same type of crypto at specific intervals and hasn't stopped, FIFO is your friend. Look into it. If you are somebody that is a spot trader, that is not a hodler, then LIFO is the one. Look into that. If you are somebody that is a spot trader and also has crypto that they want to hold on to and they believe in it, then you ought to pick two separate wallets, have two different strategies in those two different wallets. So you can pick LIFO in one and FIFO in one. You can do all that. But you need to understand the nature of the type of trader, investor, person you are, and what not only gives you the lowest amount of tax bill today, but will also help you in your strategy in making the most amount of gains and paying the least amount in taxes in future, next year, in the few months, whatever. So that picture in totality has to be looked at, not just at one single point in time. Okay? And remember, HIFO is amazing, but you lose the chronological ability. But all three of these are active in the eyes of the IRS, so you can pick and choose. But you have to be careful. I do see people from time to time, they've gone over and switched from one software to another, and they're just doing it just nilly-willy, and they're repeating the actual same crypto that they have sold in prior years, in future years, and that is wrong, ladies and gentlemen. That opens you up to penalties and fines and all types. And one could also argue that you've submitted a fraudulent tax return. So your tax returns need to be amended. Okay? All right, so now let's go on to the next section. business entity layer. Now, this is a huge thing that uh, and this is something, again, you need to understand the entity types and the state that you're in. I'm in Texas. All these entity types will dictate your type of investment you want to make, and also you need to make sure that you're tax optimized. So not only making sure that you have asset protection, but you're also tax optimized. So this is also something that you have to look in totality, and this is something that you need to ask yourself many questions as to what am I doing, what is my end goal, uh, am I taking money out every year, am I not, all of that. Okay, and that's how you get the answer. So let's talk about this. So anytime anyone sets up the entity first, typically it's always a single member LLC. Okay. So basically what you're doing is there's two types of LLCs, and then there's also LP. Yeah. So single member LLC. So the minute you set up an LLC at that right at that time, you're also getting into. So let's just say you're a minor. Okay, we're gonna get right into it. Let's say you're a minor, or you're somebody who's a subnet owner on Tau. I'm gonna pick Tau because Tau is an amazing blockchain. And you are somebody now who started mining and who has no incorporated umbrella. And so what is now a miner? Miner is a business owner, right? You have revenue and you have expenses in business. For revenue, for a miner, is everything that they're earning. Staking rewards from mining, but even though it's passive, no. But once you're doing mining, you are now active. Staking rewards from mining and actual daily mining rewards. And all of those get reported where? At a minimum Schedule C. And Schedule Cs are not your friend when you're making a lot of profit, because you have to pay 15.3% in additional self-employment tax, ladies and gentlemen. So a typical route would be that you would go out and get yourself an incorporation, basically. You would incorporate. You would get a corporation or a limited liability company in the state that you're domiciled in, or maybe a different Wyoming or Delaware jurisdiction. Then you go through different stages. First, the LLC is considered a single member LLC, right? So the IRS sees a single member LLC as a disregarded entity. The words are disregarded. That means there's no entity. It's just a umbrella. So then you need to go one step further. Then you would apply for the election, the S-Corp election, at a minimum. So then you would cut yourself a W-2, a small W-2, or a minimum reasonable compensation. And the rest of the money you will save the 15.3%. And that's how you would do this. And we have clients that, we're talking about saving 30 to 40K annually in taxes. Easy. A decent operation. So this is how you would go on about doing this. If you are somebody who is, let's just say that you have friends. Maybe you have an LLC, but it's a multi-member LLC. In the eyes of the IRS, you will be a 1065, a partnership. In a partnership, you have general partners and you have limited partners. Some of those partners that are completely dormant, let them be limited partners. They will save 15.3% right off the get-go. If you are somebody who's a GP, you are subject to self-employment tax, but then you retain liability. At the same time, you have full control of this entity. So you're the one who's making decisions. An LP structure, by default, is something that is done by the state that you're domiciled in. So wherever the incorporation happens in the LP structure, the limited partners are given more of a the LP is built for, like, for example, the real estate entities that are multifamily that invest in, and then they get all the K1s. That is what the LP structure is meant for, giving limited partners the least amount of liability, giving them the ultimate protection, and at the same time giving the general partner the most protection as possible too. So those are done by the state and also gets reported at 1065. And again, GP versus LP, tax matters 15.3%. Okay. Then now let's get into our big boy, C-Corp. Again, these are all the companies, most Fortune 500 companies are C corporations, but they have this double tax regime where it doesn't matter who the owner is, whatever profits you have, first you have to pay 21% flat tax rate on all profits. And then whenever the owners withdraw money for themselves, that is considered a dividend. And then there's qualified dividend tax rate. So then that 21% plus the 15%, it could easily bring you right back into that higher tax tier. But C corporations are good for if you have international partners, if you need to detach yourself from an entity, if you want to retain profits in the corporation while you're building this up, and maybe you have plans on going, taking this public. Then there's also the 83B election or 81B, whatever election. Again, it gives you that capital gains exclusion, but you have to know what your underlying end goal is and how you're currently set up for you to understand what kind of crypto entity do I want. So you have to answer all these questions for you to find out how do you want to set up your crypto entity. You don't just pick up and just because somebody else had said this. No. Look at all the four corners of what you're trying to do and how all this fits into the grand puzzle of your crypto portfolio, and how it brings you flexibility, makes you understand you're not getting yourself into something that is more complicated. It's easy to digest. You can you need to understand all this stuff, and then you're fully tax optimized. So again, whenever you go to a CPA or a lawyer, they need to ask you all these questions in detail as to what you're doing, where it needs to be done, what is the end goal. And don't give me the explanation of, oh, I'm going to go move to Puerto Rico or Portugal. Stop, cut that out. You can be set up in such a way that in US that you can pay the least amount of taxes here legally. So you don't need to move your entire family, your setup, your dog, your cat somewhere else, and the next thing you know, they're having to make new friends, and just because of taxes, you've completely messed up the quality of your life, and you're now away from your family and loved ones. So make sure that you're doing this properly, and then once you're set up, then it's, oh man, you will enjoy. Whether you're if you're a partnership or you're a DAO, or you're somebody, let's say that as a group of friends, they decide that they want to invest in crypto. All of that, the layers, the entity layer matters. That's the foundation of everything that you're doing. Then there's payroll, right? Business, you can do crypto payroll. You can send crypto to third-party providers and pay your employees an actual W-2 that they will be issued at the end of the year, but they're paid in crypto, and then convert the crypto to fiat and pay the taxes in the state and on the federal. Now it's all possible. So you are now a full-fledged business. Do payroll, pay in crypto, no problem. Book those entries in fiat into your QuickBooks. It's that simple. So that time is long gone where we were pulling our hair out and thinking about, well, how does this flow? Do I need to pay in stable coin, or can it be Bitcoin or Ethereum? It could be in any crypto, doesn't matter. The provider has to, or whoever the payroll provider is, they have to liquidate, take their fee, convert, then run the whole payroll. And now there are professional employment organizations that are crypto-centric that can give your employees or your contractors or employees, access to healthcare or insurance plans that would otherwise be very expensive for you to access. So now crypto is mainstream. So run the payroll in crypto. Do all that. If you are somebody who has an S corporation, you know very well that as an owner of the S corporation, you are subject to the reasonable compensation rule. So you must run a W-2. So then the government can feed money into Social Security and Medicare. Otherwise, it does not get fed into. For a partnership, right here, if you are somebody who's a general partner, then your earnings are subject to the self-employment 15.3%, which then gets fed into Social Security and Medicare. Social Security and Medicare. Social Security and Medicare. Okay, so, and yeah, that's so. So do that, and again, if you are a full-fledged business, crypto is now this other piece of your business. So do your business as normal. QuickBooks, Zero, all that stuff, regular accounts, rent, this, that, all. And then you have the crypto expenses, crypto income, crypto balance sheet, crypto P&L, and then you're consolidating and merging it with your regular business to getting that full picture and reporting it properly. All right. Now let's get into the next one, the year-end tax. All right. So tax loss harvesting. Let's talk about this. The beauty of tax loss harvesting is it's still valid today. Woo-hoo. And guess what? So before the end of the year, so today is the 20th of December. Maybe you might see this video in the next day or two, or maybe today, I don't know. But before the 31st, whichever tool you're using, I hope you've reconciled all your crypto trades. And this is why we've been very busy in this month of December, is doing all the crypto work, doing all the tax loss harvesting for our clients, or helping them do it. And that takes so much time. New clients doing their work, oh wow. So make sure everything's reconciled, then filter, then with the right tax accounting methodology that you've picked, you can easily then go and pick the crypto that is at a loss, sell it, buy it right back, use the losses to offset any gains that you've had this year, okay? And then also carry forward any net negative losses to next year and beyond. And then until you have more capital gains to offset these losses, they'll keep going in infinity. How cool is that? And again, this is for 1040s, okay? For C corporations, the rules are a little bit different. But again, the point is, yes, we actually have a loophole that is valid to this day, today, December 2025, it's valid. So use it. Otherwise, it's going to be gone. Then you have a whole year of just kicking yourself in the foot. So do tax loss harvesting now, ladies and gentlemen. You must do this right now. So now I'm going to go ahead and pull my deck and show you a graph that I have. All right, so check this out. This is what a portfolio looks like. You're buying constantly, you're converting, selling, you're buying, but it's going up, 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 up. Imagine that, let's say that this is one currency. Imagine that you purchase something for one particular crypto, let's say here at $100. The price drops down to 95. As soon as it drops to 95, you can sell it, buy it right back. You'll still have the same quantity, but now you have that $5 loss that you can take that you didn't have before. Otherwise, before you were just holding on to it for dear life, hodling, right? And hoping that it will go up, and then it will go up eventually. But still, you never got to use those losses. So when it goes up eventually, then you have a gain. So the losses that you've used right now, you can offset that gain. So then you have a full crypto portfolio, and there are so many points during your crypto journey at any given point during the year where you can continuously keep doing tax loss harvesting. And what does it mean to harvest? It's like when you're harvesting a fruit, what does it mean? Collect, pick, store. So you're storing your losses. You're finally converting your losses into cash. Technically, that's called tax loss harvesting. So do this right now, ASAP, before the end of the year. Sell your crypto that you're holding on to right now for a loss. Buy it right back. We have quite a few videos on our channel that you can go and visit and see how to do that exactly. But that is still valid to this day. So make sure you utilize it. I mean, we have people that range from a few thousand all the way down to the biggest one that we did was 1.2 million in tax loss harvesting. So anything in between, you just name it. But use this strategy. You're smart. You're an investor in cryptocurrency. You've been filing your own taxes. I mean, you're a bright individual. So use these rules. Understand them very well. Apply them to you, because you can do it. All right. So tax loss harvesting. Second strategy always is what? It's so donating your crypto. Donating it. There's no taxable event with donation. When you donate it, your cost basis is something that you can deduct in your itemized deduction. So open your heart and donate your crypto. Third thing that you can also do is a self-directed IRA or Roth 401k. Let your crypto grow into these vehicles. One is tax-free, the other one is tax-deferred. But when it's time, then your portfolio will be big and you can do lots. Fourth thing is always look out for long-term capital gains, by the way. Because why? Because long-term capital gains, they are 0%, 15%, or max 20%. And there's a look-through provision in NFTs. If you are somebody who's an NFT artist or somebody who loves trading NFTs, there's a look-through provision where if that NFT is deemed truly to be an antiquity or an art, then there's a additional long-term capital gains rate. But for now, we're not going to worry about that. Okay. So always look for long-term capital gains rate. And then if you are somebody that is heavy in crypto, I would highly recommend that you also segregate by getting multiple third-party crypto tax tools that you can connect to different wallets. Then you can run different simulations in coming up with that ideal strategy for you. Then using the transitioning in some of these softwares to keeping your data set static from year to year, and then really getting creative with your tax loss harvesting, your capital gains, your crypto income. You can get creative, but you need to be like in the weeds to do all this. But you can do it. All right. So this is your year-end tax strategy, and again, if you get a crypto LLC, I know that in so many places where you can't even get a business or institution's crypto account, then you're using your personal. You need to make sure that you're segregating or bifurcating or keeping your records separate when it comes to you personally and business crypto, because that is one area where so many people get tripped up. They already get tripped up with, in terms of, a judge can always unveil a corporate or pierce the corporate veil if there's commingling going on between you and your entity. Now imagine crypto, you can't even on-ramp in so many places. So you have to be very careful. So you can utilize all these things by keeping things independent and keeping them segregated and keeping the records for at least a minimum 7 years. Okay? So that does the actual year-end tax strategy. So please make sure you're verifying, applying, and using all the rules that we've had here in this. So now let's talk about the wrap up, the checklist, and everything else in between. So liquidity pools. Remember, there's a video out there. You can check out our channel, and it talks about how and different methods of liquidity pools. Basically, now liquidity pools are they're getting so creative where before we were only putting in one type of cryptocurrency in our liquidity pool. Now you can put in pairs for the lockup period, and then after the lockup period is done, then you'll get your return in a different cryptocurrency. So there's forced taxable events going on that you did not approve, but you still have to do the accounting for those properly. So when you bring those transactions in, you have to parse, you have to do all that. Make sure that the crypto transactions flow properly. You're recording memos in between, whether you're suffering a loss. This is something that we do with a lot of our clients, is to record keep notes, signatures, what transpired, why did we do this way, what was not available. All of that has to be put into your file. The date, sign it, because tomorrow when they do send you a 6173 letter or 6174 letter, or God forbid you are ever called in for an examination, you will have meticulous notes of what you did, why you did. Because remember, in cryptocurrency, you might not get all the records. You might have participated in exchanges that are no longer in business. So make sure keep records for a minimum 7 years. Okay. Keep wall. Okay. Don't forget wallet-based crypto accounting. Okay. Don't forget consistent inventory accounting method. For example, LIFO, FIFO, HIFO. Also, what else? There are so many things. There are so many checklists. I mean, contact our office. We'll be more than happy to give you, and we typically fill up all of our seats and capacity at the beginning of January, and right now we're already nearing that entire capacity. So send us an email ASAP so we can put you also in our line and actually give you a free consult. All right, so don't forget inventory methods. Don't forget don't forget to update cost basis and date in your centralized exchange. Otherwise, the 1099 will not be accurate. So do me a favor, filter by missing cost basis into, for example, go into your Coinbase, Kraken, Gemini, wherever you are. Then filter by missing cost basis or zero cost basis. And then those are probably the ones that are coming in as deposits from other wallets outside of your centralized exchange like Coinbase. Those are the ones that you need to update, because that's how they will recalculate the 1099 DA, is based on those. So then those need to be updated ASAP before the end of the year. Please do ASAP. Then, if you are in business, make sure to book crypto income, crypto expense, crypto capital gain or loss, and year-end assets. Oh, year-end balances. Yes, those are huge. Especially when you're, for example, when you're lending your crypto, when you're staking it, it leaves your wallet basically. So you have to tag that properly. Otherwise, when a crypto leaves your wallet, it's considered as a sale because you don't have access to the other wallet. So this is the issue in crypto. It's dominion and control. So not tagging it then gives you that capital gain or loss. And then when it's coming back in, then it's considered as a deposit or something that you have not purchased. So you're double paying basically. You're paying extra. So make sure the capital gains, liquidity pools, the parsing of transactions, the manual parsing, all of that is accurate. K1s, yeah, K1s. There's an amazing video that I did on K1s, because we work with so many CPA firms all across America, and we noticed that so many CPAs are not well versed in crypto, and it's okay. It's okay. It's a brand new asset class. It's technical, but then they're putting all of the earnings all in one box, and that is not okay. So we have to send out these emails to get them corrected. And so please make sure capital gains losses are flowing properly on K1s. Okay. What else? I mean, you can drop in comments, send us an email. I'll try to do a few videos before the year end. You just never know. Maybe there's a topic that I'm missing. I thought I'm covering most of the crypto tax and accounting topics, but there could be something that I'm totally missing. So please make sure that send that email to us and let us get on top of it. Again, this is crypto@akifcpa.com is our main email address. No, this is our crypto email address. Info is our main email address. Okay, email to any one of those, and that's about it. That does our year-end tax survival guide for crypto tax here in the U.S. or wherever you live, as long as you are abiding by the crypto tax, or you're by the tax jurisdiction, you are part of it. It doesn't matter where you live in the world. You need to make sure you're following all the rules that we've discussed today. So email us for any questions. We're more than happy to help you out. Again, this is Saim, your crypto CPA from the Lone Star State here at Akif CPA. And what do? We make crypto taxes easy, so you spend less time worrying and more time enjoying life, or more time walking the dog, or more time shopping online, or whatever it is that makes you happy. So have an amazing 2026. Happy New Year. Email us directly. We'll be more than happy to answer any questions. Like us, subscribe to our channel, and make sure that you get the front row seat to all of your queries pertaining to crypto tax and accounting here in the U.S. Thank you so much. This is Saim, your crypto CPA from